Well, I think that's a good explanation. So let's think about it this way: is in our view, the rising rate impact on valuations is mostly behind us. We see that on the growth side of the market and the de-risking that's unfolded there so far this year. We've been making the point that with the rising rate conundrum mostly priced in, the focus turns to growth expectations as we look ahead. And the issue here really has to do with investors pricing in recession risk, even though we haven't gotten to a real strong view whether recession likelihood is there for this year or next. So the key point, therefore, is that we think that investors are incrementally concerned regarding the growth outlook, and we got some data this past day that supports that.
The monetarists would normally tell you that you need at least 9 to 12 months for the Fed hikes to begin really having a significant impact on the economy. And yet we're seeing mortgage rates rise. We're seeing the market move already to anticipate where we're going to be in 9 to 12 months' time in the economy. And the markets appear to be suggesting we're not going to be in a good place. Why do you think the markets may have got this wrong then if you don't see recession on the cards?
Well, I think what happens is that the markets have many more tools to evaluate: Fed funds futures curves, swap curves, and so forth. And that data, historically wasn't available this far in advance of the risk of recessionary conditions. And the data suggests that you're going to see Fed rate hikes into the middle part of 23 with some alleviation on the other side of that. When we've looked historically at earnings versus Fed rate hikes, the tendency is actually for earnings to move higher while the Fed's hiking. It's when the Fed stops hiking that you then begin to see the fall off in earnings, which would make sense. Strong economic conditions that the Fed's responding to ends up driving the fundamentals. In this case, though, I think what investors are trying to navigate is the expectation that we've got a series of Fed rate hikes ahead of us. We're looking for an additional 350 basis point moves over the next 3 Fed meetings. And so with that as a potential incremental concern regarding the economic and therefore earnings outlook, investors are pricing this in much sooner than you would otherwise expect.